Yeah. So, and I think the reason is because when I look at this report, I don't see any relief anywhere. Even before we got to this 9.1%, there had been some sectors that were behaving a little bit better. I look at rents going up. I didn't see any relief in apparel. There was some hope, folks, that maybe with the inventory that Courtney Reagan's been talking about at some of the department stores, that you might see some relief in apparel. Not much there. I did see airline fares go down 1.8%. I don't even know what that means. I'm sure it's not going to hang on there. I guess the only question is you had double-digit 11%, 12% increases in energy. As to whether or not some of that comes off the boil in the future, given what's happened in gasoline futures markets, that they've come down by nearly $1, at least from the peak, whether or not and how that shows up and when that shows up in the consumer price is really a question. But overall, you have this unrelenting increase in prices from varying degrees, from 0.7 on rent up to 1% on food. And there's every reason to think this would make the Fed tougher right here, Andrew.
Steve, thank you for that. I want to get over to Mike Santoli, who's watching the stock market as well. What's your take here, Mike?
Yeah, pretty linear in terms of all the things Rick and Steve were talking about and how that feeds into equity prices. There's an impatience inherent in the equity market to try to look for the turn, to look for this sequence of better numbers that's going to allow us to believe both peak inflation is in place and then that the Fed can therefore possibly ease back. And so what do we need for that? Well, the Fed has told you it needs a sequence of month-on-month declines in core inflation at least. You have to kind of restart the clock when you get a hot number like this, and that's where we are at this point, essentially not being able to price in that relief. The bond market volatility has been searing recently. I mean, if you look at any indication of it, as well as currency market volatility. Equity market volatility has been actually more muted, but it really can't fully calm down. The stock market can't really fully get away from the macro pressures and maybe focus on whether earnings are priced in or not until you do see those other kind of fixed income and currency markets maybe settle down a little bit. We'll say, you know, we kind of went down almost 1% yesterday afternoon on almost nothing. We got a big options expiration. I think there's a chance you can clear some of this macro preoccupation away for the short term once we get into earnings season. But unfortunately, it's kind of a more of the same story, same treadmill that equity investors are walking on. Hey,
Rick and Steve, I want you guys just to weigh in on your respective opinions about the relative importance of I came up with 5 things in terms of that we can blame the inflation on. Okay, we got the Putin price hike. We got that. We got the reopening from the pandemic and the supply chain issues. We got the Fed flooding the world, or central bankers flooding the world with money for years and years and years. And then you've got fiscal spending, which some people say we overdid it during the pandemic to try and help people. There must be one more. I said I got 5. But what's the relative? You guys can come up with it because I've heard of all. Energy issues in this country, the green lobby, whatever you want to talk about, ESG. What do you think how would you rank those, Steve Leisman, in terms of one gets 20%, one gets 20? Because certainly we printed too many dollars. There's probably no doubt about that, maybe for good reason. 2, we probably spent too much.
All right.
So what do you
think? Get ready to laugh here, Jokers. Here's what I say. I say 1/3 to the supply side, 1/3 to the fiscal side, and 50% to the Fed.
Yeah, that comes up to that's good. You know what?
Because just real quickly, real quick, Joe, because it's the failure of the Fed in the first instance. It got the supply impact of the pandemic wrong, and it did not respond to the fiscal side. So that's why I think a 50% chunk of it, is 1/3 supply, 1/3, and of course you layer in Ukraine in there, that's important. But the Fed needed to respond to those other 2 elements.
You totally disagree with Steve in this case, Rick? I don't think you guys are that far off.
Yes. Yeah, no. Well, we're not that far off, but I don't totally agree. I think at the very, very top is energy. Okay, you know, Today, in front of the inflation day, there's so many articles about energy. Brent briefly on Tuesday went below February 24 Ukraine-Russia invasion levels. See, here's the deal. If it wasn't for all the mistakes all these countries in Europe and around the globe have done regarding overestimating renewables, underestimating fossil fuels, it would have never put Putin in this position. And the position, we get fibbed at a little bit here because the numbers of Putin's output and Russia's output are up, despite sanctions. I don't hear that very often. And I think that it's because that's the way it needs to be. We need this energy. And it's really put the world in a fix. That is at top of the list. The next down, central banks. Central banks have thought they were Hercules and Xena the warrior princess all wrapped up in one. But they're not. Because at some point, you got to stop manipulating the markets and let it recalibrate. And this recalibration still has leftovers from the credit crisis. It's going to be messy. Okay? So 40%, and then you can split the net last 20% with all your other issues.